Hey guys, Lacey here. So I'm a numbers and facts person. Put the emotions aside and look at it from an unbiased point of view. So that's just what we're gonna do today. I hear all day that clients are gonna wait until the rates go back down, and then I hear on the other side of things the continual rebuttal that if it goes down, you can refinance. So let's dive into that and look at the numbers. Now, before we get into that, I want to preface with saying that the short-term changes in mortgage rates are almost impossible to predict, as much as people like to say otherwise. I would tell a client that if they are looking to buy a house and it is the right time for their family and financial situation, that far outweighs the interest rates. Buy at a price that is affordable at the current rate, because you can't bank on financing after a large rate decrease, because that might not happen. So let's say worst case scenario, you can't afford the monthly payments, like at all. So because we don't know if the rates will come back down, let's make a game plan to get you into home ownership. Take the next few months to beef up your finances so you're in a stronger position later on. One place to start is discretionary spending. If you can cut back and possibly increase your income with a promotion, job, or freelance work, you can add to your savings and be prepared to make a larger down payment. You may also be able to increase your overall budget for a house. So paying down existing debts can help too, as that will lower your debt to income ratio. A higher credit score can help you qualify for better mortgage terms, hopefully ensuring you can get as low an interest rate as possible. If you already have excellent credit, keep it there by paying your bills on time every month. Late payments can ding your credit, and you've already worked so hard to get there. So let's keep it that way. If your credit score is lower, on-time payments can still help you, as can limiting what other loans or credit cards you apply for in the months before your mortgage. Okay, that was a lot. Now let's get into the fun part, numbers. Let's do an example on a $365,000 home. So the listing is $365,000. Let's say you're putting 5% down on a conventional loan. That means the loan price after your down payment comes to $343,000. At a 7% 30-year loan, your principal and interest only, which is no taxes or insurance, would be $2,306. Now, if you bought today and refinanced 2 years later, and your new loan would be about $343,000 plus $3,500 in closing costs, all guesstimations. With a 5% 30-year loan, your principal and interest payment would now be $1,841, and you've also gained about $22,000 in equity over the 2 years. Now let's say you wait 2 years. The price of the house will not be the same. We can't predict the exact rate of appreciation. So let's go over a few different possibilities. So the annual San Antonio appreciation rate is 5.46%. On the very, very low end, I've seen as low as 1.5%, so we'll throw that in there as a lowest appreciation rate scenario. And then to give it a full scale, we'll throw in one in the middle at 3.3%. So bear with me, I know this is a lot of numbers, but at 5.46% appreciation rate, that home that was $365,000 today would be $384,000 about. With a 5% down payment, that makes the loan about $366,000. And assuming the interest rates go down, because that's the whole point of this exercise, we're going to use a 5% 30-year loan, which will put the principal and interest at $1,963. Okay, so we're keeping this going. With a 3.3% appreciation rate, that would put the price of the home at $377,000. And after the down payment, it would be about $358,000, putting us at a principal and interest payment of $1,923. Lastly, an appreciation of 1.5%, the new home price is $370,000. After 5% down payment, the loan amount is now $351,000, and your principal and interest rate is $1,889. But with all these appreciation rates and increase of the home price, you've now lost out on equity. The money you've lost out on would be about $20,000, about $12,000, and about $5,400. So like I said at the beginning of this video, it is different for everyone, and you have to make decisions based on your financial situation. I personally wouldn't want to throw away $20,000 in potential equity because I wanted to save a couple $100s a month, especially if I am just a renter. But I hope this enlightened you and cleared a few things up. I know these days everyone is throwing tons of information at you left and right, and I want you to be informed.
I'm not a lender, and these are just general guesstimations. The final payments don't include insurance or taxes. Appreciation and closing costs could vary, so to get more precise information, or a financial advisor.
But if there's anything I can help with, I would love to help.